as we have 8 banks suppressing the price of silver to the highest degree, naked shorting, meaning they're shorting it and don't even have the silver to deliver if called for delivery in large numbers. But that's what the banks around the world, like India and China, are doing. They're standing for delivery. No one ever did that before. So when you talk about silver, it is wealth, but it is unquestionably the most undervalued asset on the planet, and it has nothing to do with supply demand fundamentals, the price. It has everything to do with these 8 banks. And these 8 banks are going to get caught. I think they are trying to stop doing what they're doing and get out of these short positions. But what does that say for the military industrial complex? It's a very sticky wicket because silver is disappearing globally, not only above ground, but below.
Recently, countries like India and China have started demanding physical delivery of silver, a new development. This manipulation, rather than market fundamentals, is keeping silver prices artificially low. These banks are now attempting to exit their short positions, impacting the military-industrial complex. As a result, silver is rapidly becoming scarce both above and below ground. 8 large commercial banks, including Bank of America, J.P. Morgan, Goldman Sachs, and HSBC, are significantly shorting commodities, particularly silver, to an unprecedented degree. This has resulted in the largest concentrated short position in the history of the COMEX market. These banks are shorting silver without having the physical silver to deliver if called upon. In response, countries like China, India, Russia, and Saudi Arabia are standing for delivery and draining silver from the largest vaults, such as those of the London Bullion Market Association. Meanwhile, Andy Schectman, who is the president and CEO of Miles Franklin Precious Metals, emphasizes that approximately 2.9 billion ounces of silver are traded daily, which is 3.5 times the annual global mine supply. This heavy trading is believed to suppress silver prices. Silver is crucial for high-tech weaponry, aerospace applications, stealth bombers, and sophisticated weapon systems, with about 500 ounces used in the tip of a Tomahawk missile. Since MLE's departure, 59 countries have formally applied to join BRICS, with 35 to 40 more showing informal interest. This expanded group represents a larger population and GDP share than Western nations, possesses significant military power, including 2 of the 3 largest nuclear arsenals, and controls most rare earth metal production and refining. However, China's Belt and Road Initiative, the largest infrastructure project in history, connects Asia, Africa, South America, and parts of Europe, encompassing 75% of the world's population and 50% of global GDP, including all OPEC countries. The West is notably absent from this initiative. BRICS nations are actively developing infrastructure in underdeveloped countries, challenging the US dollar's status as the world reserve currency. This shift is further accelerated by oil being sold in other currencies, weakening US economic hegemony, although its supremacy remains for now. Before we jump into the video clips, we'd really appreciate it if you could take a moment to subscribe, and hit the notification bell. This helps us reach more people and keeps you updated on our latest content. Thanks for your support, and enjoy the video.
There are 8 very large commercial banks. They would be like Bank of America, J.P. Morgan, Goldman Sachs, HSBC, etc. These banks are shorting commodities. Now you can see what is happening in the price of silver. You have 8 banks that are, for whatever reason, as dumb as a mud wall in a rainstorm, shorting the price of silver to a degree that no one has ever seen. In fact, it is the largest concentrated short position in the history of the COMEX market. Ask yourself, why? Why would this happen? Now, I'm going to show you why this is happening, but here is what the rest of the world is doing as a result of it. The folks in China, in India, in Russia, Saudi Arabia, this is what they're doing. Those are the vaults right now. That is the LBMA, the London Bullion Market Association. It's the largest holding of silver in the world. They're draining it. They're standing for delivery, these countries. No one ever stood for delivery before. So as we have 8 banks suppressing the price of silver to the highest degree, naked shorting, meaning they're shorting it and don't even have the silver to deliver if called for delivery in large numbers. These are the supply demand numbers from the Silver Institute. What do we notice missing? Industrial, 9%, electrical and electronics, 9%, of which photovoltaics, that would be solar panels, 20%, brazing, alloys, and solders, 3%, other industrial, 9%, photography, -3%, jewelry, 4%, silverware, 7%, the price of silver. In a very unnatural way. The London Bullion Metals Association, this one right here, who's watching all of its silver disappear, they have 800 million ounces of silver in their vaults. And 500 million of it belong to, you can see just over 800 million there, 500 belong to the ETFs, registered in the names of the ETFs, like Bullion Vault and SLV and whatnot. That leaves just over 300 million, yet they admit to trading 292 million ounces of silver per day. But that 292 million ounces of silver per day, they admit to being 10 times understated because they only show the final settlement numbers, not all of the trades that it took to get there, which would mean they're trading roughly 2.9 billion ounces of silver per day. That's 3.5 times global mine supply annually per day. They are holding the price down because of this. And they don't want the world to know that silver is needed for high-tech weaponry, for aerospace, for stealth bombers, for weapons of sophisticated nature that have sophisticated guidance systems. They all need silver. And about 500 ounces in the tip of a tomahawk.
At the end of World War II, the US dollar became the world reserve currency, replacing the British pound during the Bretton Woods Conference in New Hampshire. The US assured other countries that they could exchange dollars for gold at a fixed rate of $35 an ounce, making the dollar as good as gold. As a result, many countries sent their gold to the US for safekeeping, and the US held most of the world's gold reserves. This arrangement continued until the end of the Vietnam War, when France, noticing that the US was printing more money than it had gold reserves, demanded its gold back by sending warships to New York Harbor. The US complied, but in August 1971, President Nixon ended the gold standard by closing the gold window, meaning dollars could no longer be exchanged for gold. This made the dollar a fiat currency, backed by nothing. In 1974, Henry Kissinger negotiated with Saudi Arabia, securing a deal where the US would protect Saudi Arabia and OPEC in exchange for pricing oil in US dollars and recycling excess dollars into US treasuries. This agreement cemented the dollar's dominance in global trade. Hyperinflation necessitates drastically higher interest rates to maintain currency value. For instance, 30% inflation would require interest rates around 30%, far above current levels. This would likely cause widespread bank failures, as many are already struggling with 5% rates. Insurance companies, heavily invested in treasuries, stocks, bonds, and real estate, would also collapse. Such a dramatic interest rate spike would trigger a great reset, fundamentally reshaping the financial landscape and correcting distorted asset prices across various sectors. Let's get back to the interview.
At the end of World War II, the dollar became the world reserve currency because we took over for the pound sterling. And it was at Bretton Woods, New Hampshire, where this was decided. The Allies met, and the United States would be the world reserve currency. And we told the world that if they would take our dollars, they could always exchange them back to the government for a fixed rate of $35 an ounce. And that made our currency as good as gold. In fact, we ended up, excuse me, I'm battling some allergies. We ended up holding most of the world's gold after that too, because these countries who had been through 2 world wars were able to send their gold here to the United States, where it was safe and Western rule of law. And we would hold their gold and we would pay them $35 an ounce for it. And then they could take the proceeds, those $35, and buy US treasuries, which would yield a return for a non-interest bearing asset that they no longer had to store within their own borders. And they could always exchange those dollars back at any time into gold for 35 bucks an ounce. So it was a good deal all the way around. And that's what made the dollar the world reserve currency until the end of the Vietnam War, when President de Gaulle from France said, well, they're printing more money than they have gold behind it. We should give them back their dollars and get the gold. And that's what he did. He sent warships to New York Harbor filled with dollar bills and said, give us back our gold. And we did. But then President Nixon took a very unconventional step in August of 1971, and he closed the gold window. He went back on our promise to the world. No more exchanging dollars for gold. We're keeping what we have. And it was supposed to only be temporary. It's never opened back up. At that point, the dollar was backed by absolutely nothing. That's called fiat. And it was that way for another 2.5, 3 years until Henry Kissinger went to Saudi Arabia in 1974 and struck a deal with the Saudi kingdom. And he said to the Saudis, we will protect you and OPEC, all the oil producing countries. No one will ever mess with you. We will provide you weapons. Think military industrial complex, the need to make high-tech weapons. We will protect you and your allies who are in OPEC. But for that, you will value oil globally in US dollars. And you will take any excess and you will recycle those dollars into US treasuries. But if you see hyperinflation, what is the byproduct of that? Byproduct of that is interest rates that have to compensate for the destruction in purchasing power. You cannot have 30% inflation and 5% interest rates, or your currency dies. If you lose 25% purchasing power every single year, you're dead. So the market would dictate interest rates must be double, way higher than they are now, like 30%, or your currency dies. And so at 30% interest rates, well, think about the banks that are almost blowing up at 5%. At 30%, every one of these overcapitalized or leveraged, undercapitalized banks blows up. The insurance companies that are 95% treasuries, they blow up. Stocks, bonds, and real estate, they all blow up. It's the Great Reset. If you saw interest rates at that level, that is the Great Reset that Klaus Schwab talked about, where everything that is inversely correlated to a massive spike in interest rates resets. What would the real estate market be like at 35 or 40% mortgage rates? And it's done. And everything is done. And all of that money that has been created over the years in low interest rates has distorted asset prices.
The silver market remains dynamic, driven by the interplay of supply and demand factors. Increasing industrial and technological applications are boosting demand, while supply constraints due to geopolitical and logistical challenges can create price volatility. As investor interest and economic conditions fluctuate, silver prices will continue to reflect these complex dynamics, making it essential for stakeholders to stay informed about market trends and developments. Interesting prediction from Andy. I'd love to hear your thoughts on it. Share your comments below. And don't forget to show your support by liking this video, subscribing to the channel, and turning on notifications for more insightful content like this. Looking forward to the next video.